Welcome to the deep dive. Today, we're really aiming to do just that. Cut through all the noise, look at the sources, and pull out the insights that actually matter for you. Because, let's be honest, getting properly informed shouldn't feel like homework. And speaking of things that might sound like homework, we're diving into supplier statement reconciliations today. I know, it sounds super technical, right? But what we found in the material shows it's really about much more than just shuffling numbers. It digs into basic business relationships, getting the finances right, and crucially, avoiding some pretty costly mistakes that can really mess things up. So our mission here is to go beyond just that single number in the general ledger. We want to get why tracking each supplier matters so much, why reconciliation is key, and how you can spot those differences that, well, seem to pop up all the time.
Yeah, it really does seem like just a back office chore, doesn't it? But as you'll see, getting this right is kind of a first line of defense for your financial stability.
Right.
And it's not just for the big players. Businesses of all shapes and sizes, even individuals sometimes, run into these issues. Getting clear on this really does provide significant value. It turns tedious admin into, well, a strategic tool.
Okay, let's unpack this then. So a lot of businesses, maybe smaller ones especially, might just glance at their general ledger, see that one big accounts payable figure. You're saying that's not really good enough when it comes to who you actually owe money to. Why is it so critical to know exactly, down to the penny, what you owe each specific supplier? What are the real-world impacts if you don't?
Well, think about it like this. That single ledger number. It's like knowing the total you owe across all your credit cards combined. But you don't know which card has which balance or when each one is actually due. It's just asking for trouble. Keeping those individual supplier accounts accurate is, frankly, the foundation of a good supplier relationship. If your records are messy, you're going to miss payment deadlines, maybe even completely forget about invoices. And suppliers, they notice that. They're not running charities. A track record of late or missing payments. That can quickly mean no more favorable credit terms. Forget about trade discounts. Worst case, they might just refuse to supply you altogether.
Wow, okay. That's pretty serious.
It is. But flip that around. Imagine you're the customer who always pays on time, whose records match up. You're much more likely to get the good stuff. Better discounts, longer to pay, maybe even first dibs on new stock. And beyond the relationship side, there's the simple, vital point about catching errors. Without good individual records, spotting discrepancies is almost impossible. Whether the mistake is yours or theirs, you just can't fix what you don't even know is broken.
Right, that makes total sense. So, okay, we agree knowing the individual supplier details is vital. What's the actual document then? What should we be looking for or asking for to check these amounts?
The key document, from your viewpoint as the buyer, is the supplier statement. Now, it can get a bit confusing because businesses send customer account statements out to people who owe them money. But when you receive one from someone you buy from, that's your supplier statement. Different perspectives on the same idea, really.
Okay, supplier statement. Got it.
And this statement, it's a really important source document. It covers a specific time frame, say a month. It shows the balance you started with, then lists all the transactions during that period, new invoices they sent you, any credit notes.
Credit notes being for returned goods or adjustments.
Exactly. Things that reduce what you owe and, of course, any payments you made to them. And it finishes with the balance they think you owe at the end of that period, its main job, to help you reconcile, to check your accounting records against theirs. It's that external validation.
It sounds like it should be straightforward then. If everyone's keeping good records, why wouldn't the numbers just match up perfectly every time? What usually causes these differences?
You'd think so, wouldn't you? But they often don't match. And for a bunch of reasons that are actually pretty common, one of the biggest culprits is just timing differences. Simple as that sometimes. For instance, you've sent a payment, maybe a check is literally in the mail, but the supplier hasn't received it or processed it by the date the statement was printed. So in your books, you've paid. In their books, it's still outstanding.
Okay, timing. What else?
Well, you get accidental misallocations. Someone posts a purchase invoice to supplier A when it should have been supplier B. Easy mistake to make in a busy office. Or maybe a credit note wasn't processed. You sent goods back, they agreed to a credit, but it hasn't hit their system yet, or maybe you forgot to record it. Same for debit notes, which might add a charge. Sometimes discounts cause confusion. Was the discount taken correctly? Was it even eligible? And then, good old human error. Transposition errors are classic, typing 54 instead of 45, or mixing up digits in an invoice number or amount when entering it. It happens way more than you might think.
Right, those simple typos can really throw things off. Okay, this is where looking at specific examples really helps, I think. It makes it less theoretical. Let's take that first scenario from the material, Amelia and Charles. So Amelia looks at her records. She thinks she owes Charles $650, but then Charles sends a statement and it says $750 owed. What's going on with that $100 difference?
Yeah, this is a great, clear example. The source material points straight to it. Amelia had sent a check for $100, but critically, Charles hadn't actually received it or banked it by the statement date. So Amelia, quite correctly, recorded the payment when she sent it. That reduced the debt in her books to $650. But Charles's system, it didn't know about the check yet, so his statement still showed the original amount, making it look like she owed $750. It's a perfect example of a timing difference. It's not really an accounting error on either side, just timing. Charles's records will catch up when the check clears.
And I guess people might jump to thinking someone's made a calculation mistake when it's just the postman hasn't arrived yet, essentially.
Exactly. And it's important to see why other possibilities don't fit this specific pattern. Like, if Amelia had accidentally entered an invoice from Charles for too much money, her records would show she owed more than his statement, not less. Or if Charles had given her a credit note, say for returned goods, but she hadn't recorded it yet, again, her records would show she owed more than his statement indicated. But here, her records show less owed. That pattern points directly to that payment she made, but he hasn't received. Understanding the pattern is key.
Okay, that makes sense. Let's tackle the next one then, Morag and Halima. This sounds a bit more complex, needs a closer look at the actual invoice details. The issue seems to revolve around one specific invoice, in V105. Morag's records don't match Halima's statement for just that one item.
Yes, this one digs a bit deeper, and the source material suggests Morag likely made a transposition error when she keyed in V105 into her accounting system. Numbers got swapped. So let's say Morag entered the net amount. The amount before tax is $145. But the actual net amount on the invoice should have been $415. Big difference. Now, if you add the 20% sales tax onto that correct $450 net amount, you get a gross total of $498. And that $498 is exactly what was showing on Halima's statement for NV105. So that mismatch flags the likely input error on Morag's side.
So it wasn't just off by a few dollars. It was a significant error from flipping the digits. And what about other things? Could it have been something else?
Well, the source material helps rule things out, which is useful for understanding. For instance, it mentions credit notes don't always have to be for the full invoice amount. If only part of an order was faulty, the credit note would just be for that part. So a partial credit wasn't the explanation here.
Okay.
It also clarifies that the amount Morag owes Halima will include the sales tax. Morag pays the gross amount. Halima deals with passing the tax to the authorities. So you can't explain the difference by ignoring tax.
Right.
And that $510 balance mentioned, that was the total on Halima's statement, the supplier's view. It wasn't the figure Morag had in her books before she found the error. So that wasn't the cause either. The transposition fits perfectly.
Yeah.
So once Morag spots this transposition error, she does the reconciliation. Her books showed a balance owing of, say, $186 initially. Then she adds the correction for NV105. That's the difference between what it should have been, $498 gross, and what she'd wrongly recorded, $174, which would be the gross of her incorrect $145 net entry. So $498 minus $174 is $324.
Okay, so $186 plus the $324 correction.
Exactly. Gives a reconciled balance due of $510. And bingo, that matches the $510 balance shown on Halima's supplier statement. Everything ties up. And what's really key here, what this example shows so well, is how one seemingly small data entry mistake, flipping a couple numbers, isn't just a minor bookkeeping issue. It throws off your view of cash flow. It could damage trust with the supplier if it leads to late payment. The reconciliation is how you find and fix these hidden bombs.
That's a really good way to think about it, hidden bombs. So Morag does the reconciliation. She finds the error, corrects it. What's the actual benefit for her then? And for you listening, what's the big takeaway? What does doing this reconciliation actually give you beyond just, making the numbers match?
Well, the immediate benefit for Morag is confidence. By doing that reconciliation and finding the error, she now feels confident that, okay, this was the issue. And there probably aren't other errors lurking in her account with Halima for that period. And the action she takes next is crucial. She'd prioritize paying that corrected amount for NV105 promptly to meet the deadline. Or if the deadline had already passed because of the confusion, she'd pay it immediately and get in touch with Halima, explain the error, apologize if necessary. Communication is key.
Right, avoiding that awkward silence or angry phone call later.
Precisely. And connecting this back to the bigger picture, Doing these reconciliations regularly, proactively, means you spot these errors or discrepancies early on. You investigate them, you talk to the supplier if needed. It's all about maintaining that healthy business relationship. Good records, timely payments, clear communication that builds trust. And trust often translates into better terms, better service, smoother operations overall. It really is turning paperwork into partnership strength.
Okay, so let's wrap this up. We've really dived deep into supplier statement reconciliations today. We've seen that keeping track of individual supplier accounts isn't just admin, it's vital for relationships and basic accuracy. We learned that supplier statements are the key documents you need to verify what you owe. And we've explored why differences pop up. Could be simple timing, could be misallocations, could be those tricky data entry errors like the transposition we saw with Morag and Halima.
Yeah.
Hopefully, knowing all this feels empowering for you listening. It's not just about bookkeeping, it really is about financial health and building strong partnerships. You're not just an accountant, you're kind of a financial detective, making sure everything lines up.
And that raises one last thought, perhaps. The source material really emphasizes dealing with these discrepancies quickly and professionally. So the question to ponder is, what are the real costs, the hidden costs, financial, yes, but also relational, if you don't deal with them quickly and professionally? How does letting these small administrative tasks slide actually impact your ability to run your business smoothly, to get those favorable terms you need down the line? It connects directly back to your operational success.
That's a great point to leave people with. Definitely something to think about. Thank you for joining us on this deep dive today. We hope you can take this clarity and apply it, whether you're managing a huge company's payables or just keeping your own personal finances in order.